Let's start with your role as IVCA chairman. What are the key priorities for IVCA at this point?
So I think one positive thing is that the government and regulators clearly are now begun to recognize this as a significant and important asset class. That trend has, I think, emerged over the last few years. So at least there is good engagement at all levels. One of the key priorities that we have at IVCA is onshoring of offshore capital as we try and build India as a base for private equity and venture capital fund management, not just for investing into India, but potentially also beyond that in the future. And to that extent, we want to make India a competitive base for that. And the most important element, of course, is stable regulations, globally competitive taxes. Nobody minds paying taxes, but they should be of a globally competitive order, and predictability, stability and predictability. So those are the elements we are working actively towards. We've had some good results lately. For example, we work closely with SEBI to operationalize the AIF code for IFSCs, the International Financial Service Centers, which is an important step in that direction. There are still lots to be done on areas like GST, where there is a fairly high taxation at 18% on the fund management fee that the fund pays to the manager. And it could just be that the fund is 80% offshore money. So actually it's a deemed export, resulting in significant benefits to India, and should actually be exempted from GST. Or you have a case where the blended rate is lower for funds which are predominantly offshore money. So there are many mechanisms which can address that, and that's been one of the discussions we've had with government and regulators, and we're trying to push in that direction. As you saw yesterday, Niti Aayog Vice Chairman also said that one of the things he wants to work with IVCA is more onshoring of offshore money.
Why is that so important? I mean, we want capital from overseas. Why do we need the fund managers to be based here?
So capital is very important by itself, and it leads to jobs, innovation. It's long term, it's sticky. But if the fund management base moves onshore, it's also a lot of economic activity around it, right? When you look at centers in the world like New York, London, Singapore, Hong Kong, a lot of it is just about the economic activity around financial services. So they can be significant contributors. Why not have that onshore with the entire ecosystem around it? Also, it becomes stickier and sort of more clearly and permanently allocated to India if it comes onshore. If it's offshore, it can still got some elements of fungibility. It helps create further employment. So various elements to it. The IFSC regulation is also very important, but I think it also needs to move into the PVC hubs like Mumbai and others. I think that will be important as we move forward.
So where are we at with that, with Mumbai as an international finance center?
So that I think is, some of these issues, whether it's GST, IFC going beyond, part of it will also be pushed by the state government, or even stuff like one important issue is that expenses paid by investors into funds today are not tax deductible. So the base considered for computing capital gains is what goes into underlying portfolio companies, which is lower than the actual amount invested in the fund, because part of it goes into fees and expenses. Again, there's no logic for it. If you invest in a mutual fund, expenses are deducted from the NAV, so capital gains is on the full base, including what you invest in expense. So a lot of these items obviously now will have to be taken up post the new government coming into place. We are hopeful that we will get a lot of momentum on these issues, and as time recent months has been at least to get as much education around these issues and make people understand why they are reasonable and consistent, which the feedback we've got so far from most is that there is strong logic. We always say we have no problem paying taxes. There should be globally competitive, and this should be logical and rational. That's our only requirement, and I think on these counts all these requests stand in good ground.
It seems to me, from an outsider point of view, that a lot of education is done by the IVCA to the government regulators and stuff. Is that correct? I mean, are we still doing very basic education?
I would say there's always a need, and there are people who move around in government, and there are perceptions. So it's always required. I think one of the things now we are seriously considering, though it'll be quite a significant exercise, is actually it's pretty clear there's job creation by private equity and venture capital. But can we actually put a number to it? That would involve going to various member PE/VC funds and them going into each portfolio company of theirs, or at least a large enough sample to get a sense of how many jobs have been created since PE/VC invested. Now, some of that data is always useful in further education. In principle, nobody can deny that it's long-term sticky capital. It should help innovation, typically helps improve governance in companies. It helps businesses scale up, as Mr. Narayan Murthy said, helps become leaner and stronger. There are other elements that we need to probably also address, is more social consciousness, and some of those that we are increasingly working on. ESG is becoming important in the private equity context. But yeah, education is a continuous process that we have to spend time on.
One of the things that already is on your agenda is standardization of data and PPMs, and it's something that some of the investor LP guests have also pointed out, that Indian managers need to do a better job of selling India, and then kind of standardize data so they can get comparable data on managers. Where are you with that?
So the two separate things. Benchmarking and having an India benchmark is a useful thing. We have actually worked with a global agency called Cambridge Associates and Crystal in India, and connecting them with SEBI on initiating work towards that end. So I think that the idea is, at the end of it, we have start working towards producing an India benchmark, so that you have India returns in an aggregate available from various asset classes. Maybe PE is one asset class, VC is another. We need large enough sample sizes to segment further, but at least have an India benchmark. That's one. So that is something where we've last 6 months we've been quite active, and we've got things rolling. The PPM is a little more complicated discussion. I think globally you don't have PPMs which are standardized. And globally there are different structures. In some countries funds are not regulated at all. The fund PPM is not cleared by the regulator. The manager might be regulated. So I think that is atypical, but I think SEBI has requested that if certain elements of the PPM are standardized, it would help them process the PPM faster. And
it's for SEBI's benefit rather than for investors' benefit.
It's primarily for SEBI, but they also want to make sure that certain elements which they think are in the best interest of investors are there. If it is templatized, then they feel more confident that those elements are included, and there could be potentially no mis-selling. So that's a more debatable issue about whether it's because a lot of managers feel that their creativity in telling their story might get a little hamstrung in standardization. So but I think SEBI is clear that it wants to move towards standardization. So we'll have to, as an industry, see where the ideal balance can be found, and we've just initiated work on that.
Okay. Anything else that is on the IVCA plate that you want to share?
No, I think you covered the main items. The other one is building a strong domestic LP base, because I think that's important for sustainability of the industry. Various types of domestic LPs. We had a session earlier about pension funds, right. Insurance companies, family offices becoming more active. Again, it's education. Yeah, because people don't understand private equity venture capital so well, so you need to take them up the learning curve on that. You also need to then train LPs, domestic LPs, and sometimes we work with our foreign or large global LP members to help in that training process. We've done a couple of rounds of these training processes for domestic LPs, so that they also go into this with the eyes and ears open, fully understand the asset class. So that's another important engagement area for IVCA that we're working on, and our hope is that in the next 5-7 years you have a vibrant domestic LP base as well.
Right. But the panel discussion on pensions was very clear that the NPS specifically is a DC plan, defined contribution plan, where retail investors are making the choice.
Sure.
Only 15% comes from the private sector. They're the only ones allowed, and they tend to be lower end, so they're not likely to. So pension funds, domestic pension funds, is an unlikely source of capital for you.
As I think they mentioned, including the regulator mentioned in the panel, that you've got to be patient in this. This is not something which will happen overnight, but I think everybody was in agreement that alternative assets helps improve the net yield and the inflation-adjusted return for pensioners. It's in everybody's interest. You have the Canadian example of where it works so beautifully for pensioners.
But they have enabling environment, right? The Social Security and all that stuff.
But it's
and it's DB. It's a DB fund. I mean, Anita gets to make the call, whereas in NPS, the retail investors make the call.
But part of it is also, as was mentioned during the panel, people don't understand. Fund managers also don't understand the asset class well enough. So as they go up the learning curve, I think it becomes a virtuous cycle, but it takes time.
Right. Okay. So just closing that one, let's talk about Tata now. So just describe, or just a brief intro on the Tata Opportunities Fund.
Sure. So Tata's Opportunities Fund is the largest and sort of the flagship private equity fund of the Tata Group. We kicked off in 2013 with our first fund, which is just a tad below $600 million. And the thesis was that the Tata is a vast ecosystem. It's got several touch points which could be potentially beneficial to the fund's portfolio companies in symbiotic way, mutually beneficial. It could be business opportunities, it could be other optionalities around it. So therefore, to target doing deals with a differentiated platform where you'd be a value-added partner, and that's what we've stuck to. The first fund invested into 8 portfolio companies. We still got a little bit of dry powder there, but 8 portfolio companies. And all of them were sort of off-market transactions or proprietary deals, which is very unusual in the Indian context. And the businesses have grown very strongly. The average EBITDA growth for our portfolio is about 23-24%, which is very strong. It's much higher than the market earnings growth. We also were not necessarily following the flavor of the year. At times we made calls which were a little ahead of the curve or ahead of inflection points. For example, we invested in an auto component company called Varroc, negotiated deal 2013, closed in March 14, where PE interest was more around IT services, consumer healthcare. So that enabled us to get into a very attractive company where at that time interest was limited in that sector. Then we exited last year through an IPO of the company, and we did a 6x on that, which is in 4 years and 3 months. That exit, our first exit itself, returned 50% of the fund back to our investors. We have another deal exit under discussion, which is somewhere between 4 to 5x. So I think the fund looks quite strong on its returns. We've also invested in top quality brands, market leadership businesses. So we were very clear we shouldn't swing for the fences. We should invest into companies which are high quality, defensive, will at least ensure that we have little risks of capital erosion in them. Private equity by its nature is a high beta asset class, but within that, have high risk adjusted returns. Now we've got a bunch of exit discussions underway on the fund, but our current reckoning, I think we should end up over an overall fund at a 2x net dollar multiple of invested capital, which everybody tells us is very strong performance. So the idea is now for us to raise a follow-on fund, which will follow a similar strategy of investing into market-leading businesses, but with a slightly differentiated angle and value-added partnership angle. So pretty much in line with what we think we have done successfully so far.
Value added, sorry, with the Tata Group?
No, the value added isn't the fund itself, given its relationship with the Tata Group, can leverage the ecosystem to its benefit. And of course, the fund has its own operating partner, operating advisor, networks, and its own learnings in various industries, but can obviously leverage on the broader Tata association to the benefit of portfolio companies and vice versa.
Is there a particular unique advantage in any particular sector that association brings? So if I were to consider investing in your fund, I know that your strategy would lead to a particular sector. Would that?
No, we are not a sector-focused fund. There are a few sectors where we have quite a good understanding, and we have operating partners, etc., from that sector. But we're fairly broad in terms of our sectoral coverage. So in the first fund we had media, we had tech, auto components, EPC. That is a sort of contrarian call, because we had again a sector where most EPC companies, engineering, procurement, construction companies had gone through restructuring, Chapter 11, because they got over leveraged. So you had vacuum in the marketplace, to our mind, other than L&T, the big listed company. There were very few, so we backed a company which we felt was an exciting play on that. 3PL logistics business, where again we invested into ahead of GST rollout, thinking it's a good play on that. So it's fairly broad, but whichever sector we're investing into, we make sure we have deep knowledge. And some of the portfolio companies which we've gone invested into, our entrepreneurs tell us that we were very different from other and private equity firms that they met, in the sense that a lot of them came in the first meeting, sometimes asked somewhat basic questions, and we went in having done a lot of research and understood the industry, and sort of the first meeting itself we hit the ground running. So that we value that, and we want to achieve that. The other sort of strategy in terms of deal size we have is we target deal sizes between about $30 to $100 million in the fund, and then of course along with LPs we can do bigger deals as they co-invest with us. We feel that's a relatively more attractive segment, because there are not that many India-focused funds which are above $400-500 million, probably half a dozen or thereabouts such funds. So it's a little less competitive. The big global funds as well as the sovereign pension funds are increasingly going up in ticket size, and erstwhile years they would probably not do anything below $100 million, but now they're moving up to $150-200 million. So we feel that segment from $30 to $150 million is an attractive segment to operate in. And with our differentiated play, we feel we've got something distinctive for investors into the fund.
So how big is the second fund that you're raising?
We're looking at a $600 million fund, so slightly bigger than just marginally bigger than the first fund.
Domestic or international?
So the first fund was purely international money, apart from the Tata sponsor commitment. The second fund will also be predominantly international, but will also have not so much for the quantum of money, but will have a domestic AIF structure, which is what given the AIF structure benefits and all, we've decided to go down, and we have decided to play the role of onshoring offshore capital. So even the offshore investors will eventually come through the AIF structure. But domestic quantum will not be significant, because we don't want to go retail, or we will just go to a few institutions really to open the relationship. So just like the Tata relationship is a valuable one, sometimes having a relationship with some domestic businesses is helpful in terms of symbiotic value add between our portfolio and those institutions or businesses.
Okay, anything that you would say on the India pitch? Again, there's a whole bunch of investors who've not invested in India at all. I mean, I know my home country, Australia, probably is one of them. Is there something that you would say to them?
Yeah, I think, for example, you're right. I think the Australian alternative investors have not played India in a big way. I think I think it should it's increasingly be clear to people that India is a very important market, and you should have some exposure there. In some of the demographic elements, the fastest growing large economy. It's a fairly open economy now as well, and the quality of governance of businesses is generally becoming stronger. There is a lot of innovation going on. So it is a $2.6 trillion economy growing at 7% plus. I would say it's a matter of time for most large investors before they begin to allocate some capital to India. So the sooner they do it, the better. But some take a bit of time to get there.
So the feedback, I mean, I go there very often, and the feedback they give me is that for the amount of due diligence they have to do on ground, the returns haven't been in line with that.
So you see, there's a bit of legacies India's had from the period of around the year 2007, because pre-GFC, what happened was that there was too much froth and too much interest in India. That was the time India was being spoken about as matching China, and in private equity venture capital, you had almost as much flows coming into India as in a much larger economy like China. So some of it was clearly unsustainable, but even the PE VC industry was not so mature. The managers were relatively new. They'd come out of other businesses like banking or consulting or fund management in different geographies. They didn't understand the ground reality that well. Public markets were rich, so in private equity, managers were sometimes paying premium to public market multiples. So it was you had a lot of indiscipline in those years, and you had weak vintages around that time, and you had global LPs feeling that in general there were people who managed to do good deals even in those days. In general, the returns were weak, but I think that's changed in the last 3 or 4 years. You've had pretty strong exits coming out of India, and much more sophisticated, experienced private equity industry, less prone to some of the indiscipline or wild cyclical sort of moves of the past. So I would say it's well worth them investing some time and resources and diligence, because that's only going to grow. So you can start by testing the waters with the relatively small allocations, and gradually seek to increase it as you get more confidence about performance.